Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise tax information to real estate professionals looking to build their own customized tax planning playbook. As always, I'm your host, Evan Ross. I'm a tax director with Brown Edwards & Company based out of our Roanoke, Virginia office location. Most of you have probably had a chance to check out our podcast, but if you are new, just tuning in for the first time, please go check out our website when you get a chance. A link to that website can be found in the description of this podcast. On the website, you'll find more information on our service lines, our other service providers, as well as our other office locations throughout Virginia, West Virginia, and Tennessee. With all that, let's get right into it with the episode for today. Kind of an impromptu episode for you after the tax bill, which most of you know was signed into law on July 4th. I wanted to provide some timely information, so we likely will not have an August episode next month due to this impromptu episode in mid-July. So this is a first for me. It's actually going to be a solo episode. I'm going to be riding solo today, talking through tax legislation, what was enacted with the tax law, with the One Big Beautiful Bill on July 4th. There's a lot of information in that bill, but I'm going to try and focus on how that relates to real estate investors and developers. Before we get into the meat of the bill, usually, as you all know, all the listeners out there, I typically do a Tell Me More segment to get the show kicked off, get the episode kicked off, just kind of on a lighthearted note. So I figured this is a good opportunity for me to talk about my 4th of July weekend, what I got into. If you ever get a chance, if any of your friends, family, neighbors ever buy fireworks or decide to do their own show, definitely be a part of that. I had a neighbor invite me down the street on July 4th, me and my family. One of the neighbors went to Tennessee or South Carolina to purchase some pretty high quality fireworks and gave us our own little show in the backyard. It was kind of cool. The kids were able to run around. The fireworks were literally 50 yards away from us, and it kind of turned into a little bit of a competition. There was also two other neighbors. We were kind of in a semicircle. There was two other neighbors that were also setting out fireworks that we weren't aware of. So great show. The fireworks were right in front of us. And there's something to say about those community events and the fireworks that are set off by different municipalities. But I'll tell you what, it is nice to not have to worry about the traffic of getting out of those events. Typically, there's a lot of road closures. You're just gridlocked trying to get out. I was able to just hang out with some friends at their house and then get home within 2 minutes. So if you ever get a chance to do that, a show in the neighborhood or your friends want to go in or purchase some, or if a neighbor does, definitely go check that out, because it's definitely worthwhile to see the fireworks kind of up close and personal like that. So that's just a little bit of my 4th weekend. I hope everyone out there also had a safe and happy 4th of July weekend. With that, let's roll right into this One Big Beautiful Bill. Let's start with the timeline, just kind of backtrack a little bit on how this got to where it is today. So on May 22nd, the House passed their version of the bill, then went to Senate. The Senate, there's typically some conferencing between the House and Senate during budget reconciliation. With this, the Senate just made their amendments, made their changes, had their vote, and then they sent it back to the House. This was a very narrow vote in both the House and the Senate. The Senate version of the bill was actually a 50-50 tie, and Vice President J.D. Vance had to break the tie. It was a 51-50 pass that then went back to the House. The Senate version of the bill went back to the House. That then passed 218 to 214. So again, a very narrow margin of victory to get this passed. So the Senate passed on July 1st. The House passed on July 3rd. It then went to President Trump to sign into law on July 4th at the White House. It is now enacted law. And this One Big Beautiful Bill, I mean, it's the most significant piece of legislation since the Tax Cuts and Jobs Act, TCJA, of 2017. There's a lot of changes in there, a lot of extenders that impact businesses and individuals, as well as some sectors specifically. The healthcare and the energy industries are getting hit significantly with this bill. A lot of changes there. I'm going to stay away from the healthcare for this episode, for this podcast, just based on my audience. I will hit on a few of the energy incentives and the changes there as we work through everything. So all in all, there were a number of significant impacts to the real estate industry for real estate investors and developers. I'm just going to get started with it. There's about 5 topics I want to hit on today. There's a lot more we could talk about, but I'm trying to keep this somewhat sweet and short for you all today. So bonus depreciation, it's back, better than ever, or at least as good as it has ever been, back to 100%. If you all remember, back with the Tax Cuts and Jobs Act, President Trump made bonus depreciation 100% back then, but there was a phase-out period. That phase-out was starting, and the sunset was going to be at the end of 2026. So if you recall, bonus depreciation was supposed to be at 40% for 2025 tax year. So just for an example, so let's say that you did a cost segregation, which we talked about on an earlier episode. You do a cost segregation, you're able to carve out $100,000 of shorter lived assets. So 5-year, 7-year, 10-year, 15-year property. That $100,000, based on the old tax law, the sunsets, you were only going to be able to accelerate and deduct 40% of that cost in year one. Now with the new legislation, with the One Big Beautiful Bill, you're able to deduct 100%, $100,000 of that $100,000 carve out. That's significant for real estate investors that are looking to offset some of their other income if they are real estate professionals. So very significant impact there. I expect there's to be some uptick on cost segregation as well as the real estate market as these incentives have been increased by bonus depreciation coming back at 100%. Something new in the bonus depreciation area was also this new category, which is qualified production property. That's mainly going to impact our manufacturing industry, owners of manufacturing facilities, folks who operate manufacturing facilities. But just be aware of that if you are in that industry, that there's a big opportunity there. Although this is not actually bonus depreciation, as you may know, you elect out of that, you actually elect into this item for qualified production property. And really this is real property that is used for production. So there could still be a need for cost segregation in this case. For the most part, a manufacturing facility is not used 100% for production. There is likely a sales team in that building, office, administrative staff. There may be some research, things of that nature. So there will be a need to still carve out some of those non-qualifying components of the building. So just realize that there could be some opportunity for real property as well in the manufacturing industry. So keep that in mind. There's a lot of nuances here and new information I know is going to come with this. There's going to be questions. That's going to continue. So let's see how this progresses. Just wanted to make you aware that there is a new category of property that is available in the manufacturing area. So bonus depreciation, again, it's back. As good as it's ever been. Going to be a lot of opportunity there for real estate investors. Now let's move on to 163J, the interest expense limitation. TCJA used to be based on, your limitation used to be on EBITDA, so earnings before interest, tax, depreciation, amortization. With the Inflation Reduction Act of 2022, that calculation then went to EBIT. So earnings before interest and tax. You weren't getting that benefit of depreciation and amortization. So a lot of folks were having their interest expense limited when they weren't expecting it. They may have had hundreds of thousands in interest expense, and they were only getting to deduct a portion of that because of the adjustment related to depreciation and amortization that they were used to, that they have not been getting since 2022. We're now back to the pre-2022 legislation, so that's good news for our investors. The whole reason President Biden, the reasoning for the change going to EBIT was just to discourage taxpayers, investors from accumulating excessive debt. The new legislation has moved on from that, gone back to the old calculation. So we're going to see a lot less interest expense limitations in there. If you are one of those folks that capitalized interest during this period, talk to your tax advisor, ask some questions about what needs to be done there. We're definitely in this transition period with a lot of legislation where we need to figure out what the next steps are. Next, I'm going to talk about the SALT cap as well as PTET, the pass-through entity tax election that can be made at the entity level. The SALT cap went to $10,000. So if you were itemizing your deductions on your individual tax return, you were capped at $10,000 of state and local taxes you could deduct. So we're talking real estate taxes, personal property taxes, withholdings, any state taxes you're paying. That was capped at $10,000. So this workaround with the PTET election allowed taxpayers to pay their state taxes at the entity level, create a federal deduction for those state tax payments, and then create a credit for the state. There is an add back on the state and a credit for the state. So in theory, if you made this election, all of your income was from your pass-through entity, you would not have a personal tax liability at the state level on your personal tax return. PTET is still alive and well. I imagine most taxpayers will still take advantage of this if they have a pass-through entity. So we're talking a partnership for most of our real estate investors. Your real estate is held in a partnership, in a pass-through entity. All of that income and deductions are flowing through to you all personally as the owners. This could be a good impact for some of our real estate investors that maybe have a smaller portfolio. They're just recording their activity on either Schedule C or Schedule E of their personal income tax return, and they're not able to take advantage of the PTET election. So those folks may be able to take more advantage of this increased SALT cap to $40,000 instead of the $10,000 cap that did exist. Be aware also that this $40,000 is going to increase by 1% each year through tax year 2029. So this is only a 5-year tax law for the SALT cap increase. So just be aware of that. Also be aware that there is a phase out if your adjusted gross income is above $500,000. So it will phase down and you may not get that entire $40,000 SALT deduction if your adjusted gross income is above $500,000. However, it will not go below that $10,000 minimum. So at a minimum, you will still get a $10,000 deduction if you itemize on your personal tax return. So I believe all in all, that was good news. We expected the SALT cap to increase in some capacity. We actually had our last episode when I spoke with Rich Headley, our state and local tax partner at Brown Edwards. He spoke on, him and I both didn't think legislation was going to happen before the episode came out. Well, sure enough, the tax bill was signed into law on July 4th. Our episode dropped on July 5th. While we didn't have any definitive language in that podcast, we were off. Our expectation was this bill was going to get signed closer to August or September. But Congress moved pretty swiftly and quickly and got this done by July 4th. So next, I want to talk about opportunity zones. This is actually something that came into play for the first time with the Tax Cuts and Jobs Act. This was experimental legislation that offered substantial tax benefits for investors who reinvested into designated distressed communities. So we're talking rural areas, areas outside of your main metropolitan hubs is where the investments can be made. The new legislation is permanent. While it was temporary with the Tax Cuts and Jobs Act, this is permanent legislation now for opportunity zones. The way this works, if you have capital gains, you can elect to reinvest those capital gains into a qualified opportunity fund to one of these distressed areas, and defer your capital gains. Again, this only applies to capital gains, not ordinary income. So let's say you sell a piece of property, you have capital gains of $500,000. You want to defer that $500,000 capital gain down the road. You can invest in one of these qualified opportunity funds, which is a new investment. You'll get a K1 every year. You invest in that fund. After a 5-year period, if you stay in that fund, you get a 10% basis step up from your original capital gain. So while that may sound minimal, that's still a big impact in this situation. That's $50,000 increase that you're going to get in your basis. That's going to help you. That's going to offset that deferred gain down the road. And then also, once you stay in the fund for a 10-year period, you're able to completely eliminate any gains that are generated from the appreciation of your investment while in the qualified opportunity fund. So there's definitely a lot of opportunity there. The difficult area will be for this transition period. So I didn't mention a few moments ago, but this legislation does not go into effect until after December 31st, 2026. So we're talking the beginning of 2027. So any investments you have 2027 forward would be under this new legislation. For any investments you have currently or that you invest in between now and December 31st, 2026 are going to be subject to the old laws. So I'm not going to get into those specifically today, but if you have questions on that, please reach out to me. Pat Murtaugh, who is also a partner at Brown Edwards, works a lot with opportunity zones. So also, currently, every state has some amount of opportunity zones, designated zones in their states. There's going to be some redesignation in 2027. And from my understanding is that there's going to be about a 22% decrease in the number of opportunity zones available across the country. I don't know specifically what those zones look like at that point. Obviously, each state governor is going to have the responsibility to designate those zones in the next couple of years. So that could also impact your decision to invest now or later. There's a lot more zones available right now, a lot more investments available right now. In 2027, there may be less opportunities available because there are going to be fewer opportunity zones. Just be aware of that. If you have questions, please reach out to myself, to Pat Murtaugh. We were happy to talk through this with you, give you some more information. But again, this is pretty significant legislation that came out of the One Big Beautiful bill that President Trump signed into law on July 4th. So please consider opportunity zones. These are complex tax strategies, especially with this transition period going along. So you don't want to make these decisions by yourself. One other thing I will add is that when you choose to invest your capital gains into these opportunity zone funds, that has to be made within 180 days of the sale. So if you were to sell a property on July 15th, for instance, you have 180 days from that sale date to invest in this qualified opportunity fund. After that 180 days, that deferral opportunity is gone and you can no longer invest in the qualified opportunity fund. So keep that in mind as well as you consider this as a real estate investor and capital gains and ways to defer those gains. Lastly, I'm just going to talk about some of the energy incentives. With the Inflation Reduction Act of 2022, there were a number of green energy incentives that were encouraging investors, taxpayers to really invest in green energy, being clean, take advantage of these opportunities. Well, fast forward a couple years, we're looking at the One Big Beautiful bill. Those are being eliminated pretty quickly. We're looking at between 2.5 months and a year for a lot of these incentives. They're going to be going away. So If you're looking at buying an EV, an electric vehicle, have been considering it, you might want to jump on that pretty quickly. You have until September 30th of 2025, so about 2.5 months to make that decision, make that purchase before that credit is eliminated. Some of those can be pretty substantial. So think about that. If you are looking at buying an electric vehicle, or maybe if the credit was the reason for considering the purchase of an EV, again, you want to do that quickly, make that decision soon, have a conversation with your advisor, with your business partners, have those conversations, see if you need to expedite that process. Some of the residential energy credits, those are also going away. You've got a little bit more time with some of those incentives, but they're still phasing out, and they're going to be eliminated here soon. So, for instance, residential clean energy under code section 25D. So we're talking about your solar panels, your geothermal heat pumps, things of that nature. You've got to have that placed in service and paid for by December 31st of 2025. So you got a little bit more time than with the vehicles, but there's still a clock ticking, and you need to get that done before the end of the year. D, which is a deduction, not a credit. There's opportunity there as well, but that's being eliminated for projects after June 30th, 2026. So if you have not started a project prior to June 30th, 2026, you're not going to get that incentive. The way that works, that's investing in clean energy throughout a commercial property. There's a square footage calculation. You get a deduction based on the square footage of the building that's using clean energy. Look at that. If you have projects that are in the works or you're talking about, make sure you get those started before June 30th of next year. Now, if there's projects already started, already working on them, nothing to worry about there. Those are going to be fine. They're going to qualify for the 179D. And then lastly, 45L. That's the most common one for some of your residential stuff. You're looking at your windows, your HVAC, heat pump, things that meet the Energy Star ratings. A lot of those incentives were increased significantly with the Inflation Reduction Act. So make sure that if you're considering that, those are also ones that have to be done by June 30th, 2026. So you got a little less than a year to have that property acquired in order to take advantage of those Inflation Reduction Act credits that are available for residential energy improvements. One thing that is staying intact from the Inflation Reduction Act related to clean energy is the transferability of these credits. That essentially allows taxpayers, organizations that can't utilize the tax credits to sell those to a third party who can utilize those tax credits. You think about a lot of nonprofit organizations, they may not be able to use these credits. They may be looking at selling these credits to a taxpayer that can utilize those credits. So keep in mind the transferability is still there. If you were looking for credits, they are out there. They will be out there and available to be utilized and purchased. There's a lot of other green energy items that are being eliminated. Some of the ones that are going to last a little bit longer are the ones related to production when you're actually producing clean energy. So solar, wind, things of that nature. That's not going to impact many or any of our listeners out there. So I'm not going to do a deep dive into the production incentives related to energy incentives. So with that, that's about all I had for today on the One Big Beautiful Bill. So again, some of the bigger items for our real estate investors, we've got 100% bonus depreciation. 163J is changing. The SALT cap is increasing. PTET is still there. Opportunity zones are a great opportunity if you're looking to defer capital gains down the road and potentially eliminate some of those capital gains and help a distressed area. And then green energy, while there is still a little bit of opportunity there, you need to jump on it if you want to take advantage of those for the 2025 or 2026 tax year, because those are going away. I appreciate your time today, everybody tuning in. I hope this was good and timely information for you all. Again, please tune in, listen to our podcast, subscribe wherever you get your podcast. We're on YouTube, Spotify, Apple Podcast. We love to have more listeners, get some more feedback. If you do have feedback, want additional content, reach out to me. My email is eross, R-O-S-S, at B as in Brown, E as in Edwards, CPAS.com. Feel free to reach out to me with any questions, concerns. There's a lot more in this bill that we can talk through. It's 877 pages. So there's a lot of information in there, a lot more to come, I imagine, in the coming months, as far as how this is all going to play out with tax filings. So again, I appreciate your time today, and have a great one. We'll be back soon with more information.